Hey everybody, this is Bob with Trade Genius. Got a good friend Phil with me. If you think real estate's a great investment, your grandchildren may be able to make money. Stay tuned.
Trade Genius.
Okay, Phil, we are in unprecedented territory with real estate, just like the stock market. And I just don't see how anybody's going to be able to monetize any investment in real estate here in the short term. You want to walk them through the numbers?
Yeah, and when you say unprecedented, it's true because although we have some metrics that we've seen in terms of what we went through in the great financial crisis and that housing bubble, we're starting to exceed those levels. So first chart I wanted to bring up was the home price index, right? So this is inflation adjusted, but how expensive is it for you to buy a home? And we are at like the highest readings we've seen in decades, and we've gone way above what we saw in the great financial crisis. So we got a reading on this just under 300. The median price index reading is 150. Now, as you guys know, just like stock prices, when you get too far stretched above a moving average, you're eventually going to find your way back down to that moving average. So this would imply that the affordability of a home needs to come down about 50%. Now that has to do with wages and things like that. But the one chart that I like to look at for telling me how expensive the market is in terms of home prices is the home value to income ratio. And that's this next chart. Okay, so this is going back to 1955. So as you guys can see, we are at 55. We went through a period where it was really expensive. Home prices were really expensive, and we basically have achieved those levels, although we've pulled back a little bit. But really, to get back to the median of the home value to income ratio, which is about 3.2. And currently we're cruising up here about 4.5. So, that's, we're looking at 30-40% reduction in home prices. And that's why I use that number, because sooner or later we will get back to that median. If you told people that in 2006, right, where we had the last time we had a big peak like this, you would have heard the same sentiment where prices are never going down. It's going to be a cold day in hell before that happens, blah, blah, blah. And you see kind of the same sentiment right now. So, but the point is that these are levels that just become unsustainable, because in order to keep these prices elevated, you have to have a consistent wave of buyers coming in with fresh capital to keep prices elevated like this. And we're not printing more money, and we're not finding new buyers because the buying wave has basically dried up from COVID, from all of the stimulus, and whether or not you may want to argue PPP loans being misused, which is a thing. IRS has actually clawing stuff like that back. But one thing is for certain is that we're way, way, way over the median. And so more than likely, we're going to see housing prices drop. And the other thing too that you have to look at is builder inventory. Now, we're not anywhere near the levels we were in 2007 in terms of builder inventory, but the thing you have to look at is the rate of change. And we are going straight up parabolic move here in terms of builder inventory. There's just no demand. These guys were building out a lot of tract developments, and now there's no buyers. And the part of the reason for this too is because the interest rates shot up, and now it's becoming more and more unaffordable for people to buy homes, or the bracket, the price bracket that people were looking in has shifted lower. So all of these things combined, Bob, I think it's really hard to make a case for home prices being able to stay up here. And in fact, I think we are going to be seeing somewhere in the neighborhood of a 30 to 40% drop over the whole thing average. Some places more, some places probably a lot less, depending on inventory. But if you got inventory, I think you're probably looking at a 40% reduction from the highs.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening. Phil, it's even more than that. People approach me and say, a home is an appreciating asset. But when we're at 300% of the median, you can't make that case. And I'll make the case that it's absolutely a depreciating asset. Why do you think they allow depreciation on a rental property? Is because you have cost to maintain the home. And I think people are totally underestimating the cost that it's going to keep the home. Look, I just went through a remodel cycle, and I just actually went through a repair cycle. And the expense that's involved here in doing that kind of work is that my repair work work is like 1/2 of the annualized median income. Can you imagine other people that have, the roof start going out on them? These are $30,000, $40,000 repair bills. Even at the cheapest roof, you're looking at maybe $8,000 to $10,000 to re-roof your home. And I just think the homes are going to fall into disrepair. At the same time, you look at Florida, right? The cost of an HOA is skyrocketed. So all the cost points are heading up faster than the wages and annualized wages that people are making. Insurance, taxes, maintenance, and HOA fees are all at a higher level percentage-wise than wages. In fact, I can make the argument, and we've made the argument here, is that there is no wage growth in this country right now. We actually have wage reduction on average because the higher paying jobs are being eliminated. The lower paying jobs are still hiring, and then people are leaving the workforce. So it's going to become even more unaffordable going forward. And I think the really big problem here, Phil, is that, let's just say this does go snap to the median, okay, is that, you have governments relying on these tax levels for the appraised value of the homes, and they're going to rip right through these levels that I still think they're trending a little bit behind. And then you're going to have an additional headwind because these counties are going to raise taxes to be able to pay for the services that they expected with these higher, real estate fees. So I just think as this whole investment asset class is going to be a bust, and I said it before and I'll say it again, that we've seen the highs unless we go into some sort of Weimar Republic event. And I'm talking about in the aggregate. There's going to be places where, look at the cities. Who's going to invest in a home in a city, right? You're going to see a lot of these homes go down to $1, and it's going to be brutal. And people think that this is a great investment are going to be sorely disappointed. And the other thing too, Phil, it's illiquid. It's not like stocks. If I don't like MicroStrategy because I don't think Bitcoin is going to go a little higher, I'm out of MicroStrategies tomorrow. You can't get out of a home unless you're willing to take a massive, massive haircut. And I think this is the thing that's going to continue to drive basically lower economic growth going forward. Because I think, if I remember my statistics right, is you're looking at 14 or 15% of GDP is revolving around real estate and construction. That is a lot.
Yeah, and the other thing too to look at is that this ratio, right, it takes several years to correct. If you look at the great financial crisis, we peaked in around 2006 or so and really didn't see a bottom in that ratio until about 2011, 2012. And that's about right. That's when I started to see prices in my area start to stabilize and then slightly start increasing. So it's a multi-year process now. So you don't have to be in a hurry at all. And there's some situations, obviously, people have to buy for whatever reason. But if you're not, and you're just looking for just that reduction in home prices, I think if you're patient enough here, and you can be patient enough, you're going to make out just fine. And there's going to be a lot of people left holding the bag. And I think that's going to be another issue too, where you're going to have housing collateralization issues, right, Bob? Especially if you're collateralizing against debt or whatever like that. If your collateral drops 40%, it's a margin call essentially, right? So, there's that, and I think that might compound the issue in the bear market down the road as we get into 2025, maybe even as late as 2026 as well. So there's a lot of speed bumps that we got to navigate. And this is just one slice of the pie right now in terms of what's going on in the economy. This doesn't even factor in commercial real estate, which is a total dumpster fire. The banking sector, which is extremely fragile regardless of what they tell you. And then we have an economy that's rolling over and probably facing shrinking GDP. So tons of headwinds, but that's not news for you guys. We've been telling you guys this for months. And so if you guys want to help navigating these markets, especially as we start getting into a recession environment where it is becoming a bond-driven trade, get into the room with us. We'll be walking you through that environment. And you can head over to our specials at tradegenius.co and select one that fits you. And we'll love to see you in the room. That's it for me, Bob.
Yeah, that's all I have, Phil. And you guys have a good one. And tomorrow we're going to talk gold a little bit and give you a little silver lining with gold here in this environment. So stay tuned. Thanks for listening.
Trade Genius.